Yo, today is day 3 of the course. Now we in day 3. Since day we learned about trends already, and we learned about entries already. So now I'm gonna show you how to mark up your charts, aka technical analysis. It's pretty simple. Technical analysis is really easy to comprehend. Um, and marking up your charts, aka your zones. And marking up your charts is just as important as the trend because your zones are going to be where you get out of trades at, your take profits. Your markups are important because of your take profits. This is how you know when to get out of the market and take your money. Okay? So, the market moves in trends, right? We already discussed that. The market moves in trends. The only time market is going to switch a trend is at a key level of buyers or a key level of sellers. I'm going to say that again. The market is only going to change the trend at a level of buyers or a level of sellers. That is the only time the market is willing to change the trend. So, with that being said, price bounces from zone to zone, aka resistance and support. Resistance levels are where sellers are sitting at, and then support levels are where buyers are sitting at. So I'm going to show you how to mark up your charts so you can understand how to mark up these zones and where to specifically mark up the zones so you know where to get out of your trade at, and you know it has a possibility of switching the trend at these key levels because the market only switches at a key level where sellers are sitting at and where buyers are sitting at. I'm going to keep saying that because it really just goes off of those levels. These are your take profits. If you get in a trade, you're buying, you get in a higher low, you take it up to a level of sellers, that's where you exit your trade. And then same thing when you're selling, you get in at a lower high and then you exit at a level of buyers. And then when it gets to a level of sellers or a level of buyers, it will show you if it wants to switch the trend or not, or if it wants to continue going with that trend. And of course, I'm gonna always give you examples. So first things first, I'm gonna show you how to mark up your charts. All right. The key is where most of the closed candles are sitting at, where the bodies are at. I mark up usually mostly where the bodies are at and where price is having a strong reaction of sellers or a strong reaction of buyers. So you can just look at gold right now on the 1 hour time frame because I usually mark up on the 1 hour or the 4 hour. It just depends whatever looks the smoothest, but it should all really look the same. I love marking up on the 1 hour, and I will go to the 4 hour if I just want to see more key zones because like I said, the higher the time frame where price is sitting at, the stronger the level is because price has been sitting at that area for a long period of time. So if you're marking up on the 4 hour and the 1 hour, it's showing you those key levels where price is going to have a reaction from. And that's very important because that's how you get your entries, and that's how you know if the trend it has a possibility of switching. Okay, so I'm gonna start off on the 1 hour because that's where I usually like to mark up my charts at. So let's start off right here. I usually use a rectangle or you can use lines. It just depends on the person. I like to use a rectangle because price isn't always going to get exactly into that zone. It might get near it and then have a reaction. Meaning it's not always going to perfectly, like down to like a T, always hit that zone to perfection. So usually when price gets around that zone and I see it getting around that zone, I just exit my trade. No need to be greedy and try to push out some extra amount of cheese or extra amount of money because sometimes when you try to do that and be like, I'm up $5,000. I wanna get to at least 5,100, and then price reverses on you, and then now you're back down to fucking like $2,000 because you got too greedy. Once price gets around your take profit, um, and you see it starting to have a little bit of resistance from that area, or you see it consolidating at that area, take your money. You can always re-enter a trade. Like taking your money is not a bad thing. You can always re-enter. Remember that. You can always re-enter a trade, but you can't always get that money back that you know what I'm saying, would have made. So take that for what it is. So boom. First things first. Where is my sellers and buyers sitting at? This is how I look at charts. Where are my buyers? Where are my sellers? Well, we know right here there's a heavy level of sellers. So I will mark up this zone, and I usually mark up these zones all the way across because these zones is where price is usually going to bounce off of. So this is my first zone. And why is this my first zone? Because every time price was here, under this level, sellers were pushing price down. As you see, it got to this level, sellers were pushing price down. It got to this level, sellers were pushing price down. It got to this level, sellers were pushing price down. So I know once price gets to this level, anything under this level can potentially become bearish, right? And then above this level, as you see, when price is above this level, price is bullish. Price above this level is usually bullish. Even if you drag it all the way across, you'll see every time price is usually above this level, the buyers are kicking in. You see this level, boom, buyers are kicking price up. You know, so that's why marking your zones are important, because price bounces off of these key levels every day, all the time. Price is going to bounce off key levels. That's what it does. These are your take profits, right? So I know sellers are sitting here pretty heavy. So that would be a zone that is marked up. And I know buyers are sitting right here at this level, because price right here, even if you look to the left, price got right here, and price originally broke out from this level. Like you see this strong bullish momentum. So this is a key zone because price above here, price pushed up where buyers are here in control above this level. And then you see when it got right here, buyers were in control when it got to this level and pushed price up. So that's another key level. Anywhere where price has a strong push to the upside when it hits the area is a key level, and anywhere where price got to a level and strongly pushed price down is a key level. Any strong reaction is a key level. And look, price to your left and is can be a factor always, because once these zones are marked up, I usually drag my zones over, because previous zones, people are waiting for price to get to these zones in order to put in orders at certain levels and push price up or push price down. So sometimes when price comes down, it's going to react off of a old zone that where price previously had broke out of. As you see, this level where price had bought up, you see what level was price bought up, boom, it came and tapped back into this level. Yeah, it broke into it and came to this level of buyers. Or here, this is level of buyers also, because price had broke out of here. It got to this level, and then price came back down, created a higher low, and pushed price up. And you see, once price pushed up to this zone, it smacked this zone, and then came back into this zone before it pushed price up. So that is considered a key level. So marking up zones are very important for that reason. You'll see price bounce off of zones on a regular basis. And I'll show you some more examples. Right here, you can mark up this zone because when price got here, buyers are sitting here. Anything above this level, price was pushed up. Sellers were sitting here because anytime price got to this level of sellers, right, as soon as it got to this zone, it kicked price down, and even look, pay attention, because even when it broke out of this level, this was a level of sellers right here, and then when price was right here in this zone, price under this level was bearish, price under this level was bearish. So as soon as it tapped into this zone, the sellers were sitting here and it pushed price down. And then once it came down to this relative area of this zone, as you see, once it broke out of this zone, it used this zone as a level of buyers. And then it tapped into the zone. And then above the zone, it was pushing price up. So that's how you really mark up charts. And the reason that marking up these charts are important, because these are where your take profit zones will be, um, usually. And so I'm looking for a buy position right here, right? Price tapped into this level, created a lower low, lower high, a higher low. It broke a lower high, created a higher high, and then a higher low from this level. We know that buyers are sitting here. So if I was to take a buy setup right here, I'm taking it to this zone and seeing what it's doing off of this zone, because I know sellers are sitting here. So if I take a buy, I'm taking price up to this zone and seeing if it rejects it, because when price was here before, it had a strong reaction. So price is going to buy up until it gets to a level of sellers, and then if it wants to change the structure, it's going to change the structure until it gets back to a level of buyers, and then it's liable to switch the structure again. So if I was to take a buy right here and then it taps into this, I would have took my money right there, because I know as soon as price gets here, sellers are in control from this level, and then they would have pushed price back down. So that would have been my take profit if I was buying. Same thing when you're selling. Let's say I took a setup. Let's say I took a short right here. Price came, created that lower low and that lower high, and as soon as I seen it create that lower high, I took this setup at a lower high. Then I'm taking price down to a level of buyers, because you see, as soon as it tapped into this level of buyers, this level right here, where look, it tapped into it, meaning as soon as price got here, it pushed up, because buyers were once sitting at this level and pushed price up exactly from here, and sellers were sitting here and pushed price down and then pushed price up. So that would have been my take profit, because as soon as price would have got to this zone, I know buyers are sitting here, I would have got out of my trade, because I know that price is liable to reverse at a level of buyers and a level of sellers. So that's how you mark up charts and mark up your zones, is you look for strong reactions. This would be a zone. This is a zone that I marked up because as soon as price got up here, it broke out, had this strong bullish momentum, and I know sellers are sitting here. I know sellers are sitting right here, because as soon as price got here, it pushed price down back to this level of buyers. See, it bounces off from zones and zones. You know how I said consolidation is when price bounces off from zones to zones? That's just sellers and buyers fighting right now until they figure out who wants to be in control. So if these two are fighting from this zone down to this zone, we don't really know what price wants to do for real until price shifts back to bullish, or price shifts back to bearish, or if it starts creating more higher lows or lower highs. So until we know what price really wants to do, what the structure really is, you just don't trade these zones too often, because you don't know what price wants to do until price shows you what it wants to do. And this is an example. Sellers are sitting here, buyers are sitting here. So consolidation zones are just buyers and sellers going back and forth, and you don't have a clue what price really wants to do. So this will be consolidation. You see price is bouncing off this zone, bouncing off this zone. It's not breaking any zones. It's not breaking nothing. It's just going back and forth until you start seeing it break this lower high, create a higher high and a higher low. Then price starts showing you some structure, and you see it break out of this level of sellers. Anytime price breaks a level of sellers or level of buyers, it's usually going to use that level that it broke out of as another level of who broke that level and who's in control. Don't overthink it. You see sellers are sitting here. As soon as buyers break a level of sellers, now that previous level of sellers is going to be a strong level of buyers, because we took out all these sellers out of this level, meaning we broke this level, and now price is going to use this level that once was sellers, instead of resistance, it's going to use it as support. Once price that was once resistance and price breaks that resistance, it's going to use that level as a form of support. Same thing when price breaks a level of buyers. Let me see if I can find you an example. You see, right here, this is a level of buyers. Buyers were sitting here, sellers were sitting here. As soon as price broke this level of buyers, because price had broke out from this level, as soon as it broke it, it now used this level as resistance, and sellers were fully in control in this market right here. As soon as price got here and it pushed price down, it was using this support is now resistance because it had broke it. And then you see as soon as it breaks this level again, it starts using this level as support because the sellers got taken out here. More examples. Levels of sellers, levels of buyers. This is a key level. This is why I marked it up, because anytime price was here, sellers are in control under this level. As soon as it got to this zone, buyers were in control above this level. Same thing with here. Sellers at this level, heavy level sellers, because anytime price got here, it had a reaction. Heavy level sellers, because anytime price got right here, it didn't want to go any higher. They see it tap back into it and then push price down. These zones are very important. Marking up your charts are very important. Boom, this is a level of buyers because when price was here, push price up. We know sellers are sitting here because when price got here, the sellers were getting pushed down. This is how zones work. Sellers, buyers. This is how the market works. Sellers are sitting here. Buyers are kind of sitting at this level it initially broke out of. And when I said when price breaks the level of sellers, sellers were sitting right here. Price broke out of it and used that level as now a level of buyers. So remember that. Anytime price breaks any structure or level, a key level, it's going to use that resistance is going to turn into support. And if it breaks a level of buyers, it's going to use that support as resistance. This is how another way to mark up your charts. You know, at the bottom of here, there's buyers sitting here because when price broke out of here, buyers are sitting here. Boom. Price tapped into this level that it usually broke out of and used this level as support and then shifted the structure. Buyers are sitting here tough and they push price up. And then price got here to this level of buyers. As soon as it tapped into this, came back up, tapped right back into the zone, and then continued to push up. And that's pretty much just how you mark up zones. And these zones are your TPs. All right, so now that we know how to mark up charts, let's talk about your take profits. These levels are your take profits because price is going to tap into these zones and have a reaction out of these zones. So it's so important for you to know where your buyers and sellers are sitting at and mark up your charts, because as you see, price broke out of here and it reused this level as a level of buyers to push price back up. And you see it got to this level of sellers and pushed price back down. If I'm taking a trade, right, price breaks out of here, creates a higher high and a higher low. Remember, it's still going to follow the trend, but when your take profits or your key levels or sellers are sitting at, right, if I take this setup and it creates a higher high and a higher low, I get in off this higher low, my stop's below the higher low, I'm taking it to this level of sellers because as soon as price got here, it had a strong pullback. So I know as soon as price gets relatively in this zone, it's going to have a pullback. And you see, as soon as price got here, it had that pullback. These are my take profits. A level of sellers. You're always taking the buyers to the sellers, and you're always taking the sellers to the buyers. And you see, this was a heavy level of buyers sitting at this relatively around this zone. Not everything's always going to be perfect, remember that. But you see, buyers had originally broke out of here, so when price shifted back bearish, created a lower low and a lower high, price came all the way back down to this level of buyers before it had a strong reaction. And then price created a lower high and then pushed price down to this level of buyers before it had a different reaction. So these are key levels that you need to be marking up and understanding where your zones are at, because these can be potential take profits levels. And this is gold. I love trading gold and I love trading Bitcoin and USD JPY because those things follow market structure real heavy. So I like trading stuff that follows market structure. Look, higher high, higher low, higher high, higher low, higher high, higher low, and then a couple of higher lows, slowly trickling up. I like to trade things that follow market structure. I don't like to trade things that don't follow market structure and price looks sloppy, because you're just setting yourself up for failure. If you're taking a trade and price is not giving you the structure you need, you always want to trade things with structure, because structure is the easiest way you're going to find a setup. If price is following higher highs, higher lows, lower highs down to a T, then it's giving you a good setup. It's very clear. You have clarity, and so it makes your setups be it makes your setups easier for you to take, so you don't overthink it. You know? So that's also key. So you want to stay trading things that look good, you know? Things that look smooth, that ain't sloppy. You don't want no sloppy consolidation. You want to see price be as smooth as possible. Smooth as possible. If price doesn't look smooth to you and you can't tell a clear direction, then you don't take the setup, because uncertainty means that you're setting yourself up to lose. You don't want to be uncertain. But also, that's why I say zones are very important. Zones are always important. Look, check me out. This is a level of sellers. As you see, when price got here, it had a strong reaction, created a lower low and a lower high. Watch how price uses this level right here, where it created that lower high. Watch it use this level as a level to where price had a reaction from and ended up dumping, because sellers were sitting here. Boom. That's why I say mark up your zones that's to the left, because you see as soon as price tapped into this zone, it created that higher low and created a lower high, and then tanked. Even right here, like I said, it's not always going to be perfect. Even at this level, boom. Price got to this level right here. Remember, when price got here, it pushed price all the way down to here. So as soon as price tapped into here, it had a reaction and switched the trend. So these are your take profits. If you would have, let's say you would have got in at this, credit that lower high, but credit that higher low. Let's say you took this setup. Oh, that's the wrong fucking. I'm looking for buys. I'm looking for a long position. Let's say you took this setup. Boom. Your TP would have been here. Stops would have been below this lower high. This higher low. And you would have took right here. You would have made some money, you know, because price got there and had a reaction. This is why your zones are important. So this is how you mark up charts. Key levels where price gets to a level and it has a strong push down. Right? So as you see, price broke this level of buyers and used this level as it was once support. Now it broke it, and now it's a level of resistance. Price didn't want to go above here, and then started tanking. Started dropping. Lower low, lower high, lower low, lower high, lower low, lower high. This is also a level of buyers. It broke, boom, came back down, hit this level of buyers, and then price pushed back up, created a higher high, broke that lower high, created a higher low, and got up to this level of sellers. Sellers were sitting here at this zone because, remember, it broke this level of buyers. Buyers were sitting here because price got pushed up from this level. It broke it. Now, once it got to this level, it used it as a level of sellers until it got back down to this level of buyers, because buyers were sitting here and they pushed price up from this level. And this is live, actually. Pushed price up from this level, came back down to this level, and then, had a push up. And now it's tapping into this level. So these would be another key level of buyers that you would mark up to see where price can potentially bounce off these two zones, or if it wants to break the zone and continue to buy up. So that's where your TPs will be at. Remember, your take profits, when you're taking a buy, you're buying up to sellers. And then when you're taking a sell, you're selling off to buyers. You have to take your contract to a buyer or a seller. And also remember this. Price will not reverse on you until it gets to a certain key level. Price is only going to switch and switch the trend off of a key level. Always. It doesn't just flip on you in the middle of nowhere. Like, right, you see prices breaking out right here. It doesn't just flip on you until it hits a certain key level, and then it's going to resist that level and consolidate and show you it no longer wants to go ahead before it does anything. Price is going to give you time to get out at certain levels. Um, so you got to understand the signs of price not wanting to pass a certain zone. Right? So as soon as price got here, it started rejecting this level. Like, get out of your trade and take your money at this level, because you know price can have a reaction from it. Even if you would have bought up from here and you see price got here, it still created a higher low and a higher high, higher low. Structure is still good. You know what I'm saying? And then it gets to this level and just starts consolidating for hours. Get out of your trade, take your money, and then let price do what it does. You take your money and then you let price play out. You always want to wait and see what price wants to do before you take a setup. You gotta let it build its case, man. Like, you can't lock up somebody without no evidence. So it's the same thing with trading. You can't take a trade, you can't take a setup unless you got evidence on what price wants to do. You don't execute. You can't execute if you don't have evidence. It's like a case. You can't lock somebody up if you don't have evidence. You don't want to take that case. You're not going to win that case if you have a lack of evidence. So you're not going to win that trade if you have a lack of structure, a lack of evidence of what the market wants to do. So you let things play out and show you its hand first before it does it. This is why the trends are so important. The trends are very important. Okay, so that's how you mark up zones. That's really it on how you mark up zones, and what your take profits would be. If you're buying up from here, you're taking it to this level of sellers. You see price gets here, sells off, comes back up to this zone to create that lower high, shifts back bearish, and goes to this zone of buyers where it initially broke out of, and then it had a reaction and shifted the structure. Um, so those are really key levels. Um, that's pretty much it for take profits and marking up zones. I hope you got a good understanding of that. If you don't, please drop a comment and be like, oh, I still don't understand. Really, it's self-explanatory. Anytime price has a strong reaction of red candles and gets to a zone and doesn't want to go past it, that's just where sellers are sitting at. Anytime price creates some type of support and doesn't want to go any lower, and price pushes up from that level, price has a strong bullish amount of candles, a lot of blue candles, and it doesn't want to pass a zone, that's where buyers are sitting at. That's how you mark up your zones. And previous zones are sometimes, or most of the time, used as a level to where price can bounce off of potentially. So always have key zones marked up, and when price gets to that zone and you see it being shaky at that zone, take your money. Just get out of the trade. Take your money. Like, it's better to take your money and you know what I'm saying, and then rather waiting on in price and then you lose your trade. Because look, price got to this level of sellers, created a lower low, lower high, and then it dropped all the way down to this zone, had a reaction, came back, and then it switched the trend. Price is only going to switch the trend at a key level of buyers or sellers. Look, as soon as it gets here, it breaks structure, creates a lower high, and goes back to this level of buyers. Now, that's pretty much it for marking zones. The next video, I'll discuss more about. I'm gonna discuss trend reversals and how the trend switches and how to spot the trend switching, and how sometimes these levels can create higher lows or lower highs at these key levels. And I'm gonna talk about that in the next video. But that's pretty much how you mark the charts, and that's pretty much where your take profits are at key levels. Boom, sellers taking it down to the buyers, buyers taking it to the sellers, sellers are taking it back to the buyers, buyers are taking it up back to the next level of sellers. Once price breaks a level, it's looking to go to that next level of sellers. Also keep that in mind. So let's say price breaks this level of sellers, it's looking to go to that next level of sellers. And if price breaks this level, it's looking to go to that next level of sellers. Same thing when price is buying. If price is coming down, boom, and it breaks this level, it's going back to that next level of buyers when it's selling off. It does the same things. Look, price breaks this level, it's going to that next level of sellers. Price comes back down and finally breaks this level of sellers, and it's taking it up to that next level of sellers that are sitting somewhere over here. Well, these are all-time highs, so all-time highs is a little different. When you don't have nothing to your left and everything is all-time highs, it's kind of hard to understand where your take profit would be at all-time highs, because price has never been there before because it's all-time highs. But most of the time, if price has somewhere you can look at a zone, price is going to break this key level and go to that next level anytime it breaks structure. If it wants to, you know what I'm saying, if it's holding that structure. You see it breaks this level. It breaks this level and goes to that next level. These are your take profits. Same thing when you're selling. If price is selling and it breaks structure, it's going back to that next, going back to that level of buyers. That would be your take profit. That's where you exit a trade. And I can even show you examples on Bitcoin, because not just gold, all markets move like this. Every single market moves like this. You see? Boom. This is a key level of buyers right here. This is like a key level of sellers. Price comes back here. Sellers off to this level of buyers. Buyers push back up to this level of sellers. Then sellers push back to this level of buyers. And then price goes up, taps into this level of sellers because price had came down. And then price comes back down to this level of buyers. And then sellers get, buyers kick back in and take it to this level of sellers because price created that lower high right here. So it gets into here, taps into here, and then tanks and drops back down to this level of buyers where price had broke out of, and then price pushes back up into this level of sellers and then takes it back down to this level. So it does the same things. So just be aware of that, and understand your zones, because even USD JPY does the same thing. As you see, price, buyers are sitting here. Price came back up, pushing into this level of sellers where it had broke out of, tapped into here, switched the trend, and dropped all the way back down to this level of buyers, and then pushed price back up. So these key zones are important. Making sure you understand where your zones are very important. Do not trade without marking up every single possibility and understanding every zone. And as you see, once it breaks this level of sellers, it reuses this level as support that once was resistance. So just remember that. It's pretty easy to mark up charts. Technical analysis is most likely the easy part. Really executing is the hardest part about trading, and that's about it.